Okay, so this is what I'm going to do with economists and analysts' predictions on CPI going forward. Whatever they say in the run up to a print, inverse the plus or the minus, and then if it's an odd month, double it. If it's an even month, halve it, because nobody seems to know what's going on. Welcome, good evening to the live stream. It's Rob Stewart with you. It is Wednesday evening, and today we're going to be covering the detail that was in today's CPI print for August 2023. If you've been living under a rock, you won't have seen that everybody's predicting it's going to go up, but it came down. So we're going to see if that's a good thing, a bad thing. Before we do that, as we are live, please give me a thumbs up if you can see me and hear me to make sure all the tech is working correctly. Neil, looks like you can hear and see me. That is fantastic. Welcome to all my regular subscribers and watchers. Welcome to all the new subscribers and watchers. I know we are growing quite quickly at the moment. If you're new to this live stream, what I do on these sessions is aim to crunch the numbers behind whatever analysts we're looking at, whether it's HPI, house price index, or inflation, to try and make better and more informed decisions of what's going to go on in the future. So I'm very much looking at trends, looking at data, and getting beneath all of the mass market, mass media hysteria or doom and gloom, and also some of the sort of agendas that we see on social media and YouTube. So that is my aim. So good evening to everybody. If we are on the replay, please do put your comments in as we go through, as if you're on the live. What I will do is go through all the data, and then I'll come back to questions at the end, because what I want to do is try and get the data succinct, so we can go through all of that, and then we can have a discussion about it at the end. So people watching on the replay can get all the data first without all the Q&A. So without further ado, let's jump into it. And before I go into the CPI data, I do want to acknowledge that we also had the UK ONS house price index released today. The headline figures was we had a month-on-month increase again of 0.6%, probably higher again than people were expecting. Now, that actually takes us down, because of the year-on-year, to, 0.5% month-on-month. It takes us down from 1.6, I think it was last month, to 0.6% annual change in the UK house price market, according to the ONS. Now, I've not looked into any of the actual data here, and to be honest, I'm not going to do dedicated episodes or dedicated live streams on the UK ONS, because effectively it's kind of in lockstep with Halifax, just about 6 months behind. If we look at the graph, we can see this is the UK ONS graph. We have had our sort of little dip, and we've had another rise, which, if you follow the show, is exactly what we have had in the Halifax index. I'm just going to go drawing here, so we can see with Halifax we had the big dip, and then we've had a rise, okay, and now we are back into decline. So it's sort of that what I was talking about last time, that double top. Just to go back onto the UK ONS there, if we look at it, just eyeballing it, and all I've done is eyeball, haven't had time to crunch any numbers. It looks like the bounce has been a little bit higher on the UK ONS than the Halifax. I suspect that's because we probably saw some early cash flowing in, maybe some too early cash flowing in to buy stuff in the effectively what was Q1 of this year, when there was a boost in sentiment. So that's what we're seeing. I would be very surprised if it carries on going up for much longer, because if we go with the Halifax, it's going to come back down again. So that is all I want to cover today on the UK ONS, because I really want to be diving in to the CPI print and looking at the data for this and analysing it all. Okay, so let's look at the highlights, just in case you haven't seen the highlight figures. I'm going to start with the positive. Now, a lot of people, analysts, economists, myself, said we're probably expecting a little bounce in CPI because of the surge in oil price. All right. Now, I'm going to come back to this in a minute. Let's just hold that thought for a little bit. This is the headline data of what came out. So the CPI, which is the overall index, dropped from 6.8% in July to 6.7% in August. So a 0.1% drop month on month. CPIH, okay, which is CPI with housing, owner-occupied housing costs included, dropped from 6.4% in July to 6.3% in August. So again, 0.1% drop. Core CPIH, which is taking the volatile commodities out, utilities, etc., dropped from 6.4% in July to 5.9% in August. That's quite a substantial drop. Now, a lot of the narrative over the last few months about the sticky inflation has been that core CPI. So when you strip out all those volatile utility costs and the volatile parts, it's that core CPI that's been sticky. And now we've seen quite a substantial drop. So on the face of it, lots of back slapping, hand slapping, high fiving. Boom, we've done it. Inflation is done. It's fixed. It's coming down very quickly, despite what people were talking about with the oil increase in prices. So that's kind of what's been talked about today, I would say. However, let's deep dive. Well, in fact, before we deep dive, let's put this in context. And somebody put a comment on my community post earlier and said maybe they were just leaking an increase in this month. So when we had what is a tiny drop of 0.1% overall, right, it actually looks like really good news. So in the context of everything, right, it's dropped 0.1%. Now that's a long way to go from 6.3%. In fact, sorry, 6.7% where we are now with the overall CPI to get down to Sunak's target of 5% by December. So we've got, 3 months to get there. We're not going to get there very quickly at 0.1% a month. So it's not an extraordinarily big drop. However, those are the headline figures, right? That's the feel-good factor. And by the way, that is good. That is good. We don't want inflation to carry on going up. I would like to clarify that I'm not here being a doom monger saying I want inflation to go up and I want everything to crash. That's not true in the slightest, right? I just look at the trends and try and make decisions based on the trends. So when we deeper dive, CPIH services. So the CPI, right? And I'm focusing on CPIH, which is with the owner-occupier housing costs included. So you see the two metrics, CPI, CPIH. The reason I'm looking at CPIH specifically is because the ONS themselves say that's the most accurate figure of where inflation is when you put the owner-occupier housing cost in. So the CPIH and CPI is broken into two things, goods and services. The services dropped from 6.5% to 6.1%, so there's a drop. The goods rose. So when you split it into, the price of stuff that we actually buy has gone up over the last month. That is not good. And what is even less good, especially if you're a homeowner or you're in sort of property, owner-occupier housing costs have also risen from 4.5% to 4.8%, a 0.3% increase. That's fairly significant. Now, if we look at this on a graph, and we're going to come back to this later on. If I zoom in, okay, the light blue is CPI. The medium blue is CPIH, and the two are quite similar now. This dark blue at the bottom, okay, which is on this what appears to be a little bit of a parabolic increase, is the OOH, which is the owner-occupier housing cost element of that CPI. And that is starting to gather pace in how it goes up. And we're going to dive into this deeply on this session because we need to understand the data behind why the OOH is going up and what it means and why I believe, and I said this in the thumbnail, or I put this in the thumbnail and the title of this video, where I believe that this entire CPI print that we're now seeing is skewed so far away from reality, right? Is it even valid to look at it as a valid mechanism for controlling interest rates? Okay, so we're going to talk about that and analyze that on this session. Okay, let's look at the last 12 months of the data. Now, I think it's worth clarifying at this point that CPI is a trailing 12 monthly change, right? It's a delta in year on year. So to understand the trend or to get a better insight as to what's going on, we need to understand where we were a year ago. If we look at this August, right, and I'm going to focus, so let's just take away the, not that much, let's just take away the CPI bit. Let's just focus on the CPIH bit, okay? In August, we're 0.4% up month on month. You can see in August 22, we were 0.5% month on month. So actually, we've dropped because we're slightly lower than August 22. If we look at September 22, right, we're 0.4. So as we go into September, when we're looking, month on month, there's less of an increase in September 22. So we'll look at how that's going to be relevant as we go into next month. October, there's a big old month on month rate increase there, right? So we can anticipate probably that October we're going to see quite a decent dip, depending on what happens with various aspects. But then look at this. Look at where we're going here, right? So this quarter, November 22 to January 23, in those 3 months, we saw a net 0.4% increase. This is going to be very interesting to see what happens with that same quarter as we go into 23 to 24 and how that affects that inflation figure as we go through Sunak's pledge into the beginning of 24 and how that's going to affect the interest rate decision. Okay, so that's just something to bear in mind as we go through this. Now, we're almost in a game of two halves here. In terms of we've got push, we've got pull in terms of what's overall contributing to this CPI figure. If we draw the line down the middle, anything that's this side, right, is negative. So that's reducing the CPI figure. Anything that's this side is increasing the CPI figure. So we can see we're broadly split. Now, let's look at the main factors that have taken us down. Food and non-alcoholic beverages, and restaurants and hotels. And I have a massive bugbear with this, right? If you were with me last week or the week before when I talked about the weightings, we're going to dive back into the weightings again, because I think this entire thing is skewing the CPI index unfairly to where it actually is in reality. Now look at all these goods, right? All the goods are back on their way up. This is not good news. Transport is spiking big time, and that is almost entirely due to the price of oil. 2 months ago, when CPI started coming down big time, and people were going, we fixed it, but it's almost exclusively due to the price of fuel going down, we're now seeing the reverse. We're now seeing the price of fuel go back up and going up more than a lot of people suspected. Now, this is going to take a while to feed into the system. So we cannot be high-fiving ourselves as oil, right? We're going to look at the price of Brent crude in a bit, and we're going to look at how it goes into the supply chain. As this starts to spike up and how this goes into the supply chain over the next 1, 3, 6 months, this has to be a worry for anybody who wants CPI to come down over the next 6, 12 months, okay? Unless it suddenly goes back down again. We don't know about that. So let's look at these offsetting factors. Main decreases, food, restaurants, hotels. Let's look at food. Yep, food's coming down. We're still, what's that, 14% annual inflation on food and non-alcoholic beverages. So we're still year on year, 14% up. So it's coming down, but we're still 14%. Interestingly, I believe I saw an article recently that food production is now deflationary. So it's actually costing less than it was to produce food, or certainly a month ago. Things are changing now again. So we would expect this to be coming down very rapidly. But yes, food is coming down. That's a big offsetting factor. Here's the annual inflation rate for restaurants and hotels. That is coming down quite a lot. And I want to zoom in here, and we can see we've had this big spike down. Now, accommodation services, hotels, one of their main costs is going to be utilities. Okay, utilities come down. Maybe they're coming off their fixed rates. I know I come off one of my fixed rates in my scaffold business in a couple of months' time. So depending when they're locked in, their utilities are going to be coming down. But what I suspect is more at play here is less people are using it. Less people are out there on holiday using accommodation, using restaurants and hotels. So that supply-demand, okay, supply-demand curve, if less people are using, clearly the price is going to come down as things get more competitive. Or there's more people entering the market again, makes it more competitive, and price of food and utilities coming down. But we're going to go into the weightings in a bit and show why I believe this is disproportionately skewing the data. This graph here is disproportionately skewing the data. So we'll go into that in a little bit. So those are the main decreases. Now, if we look at the main increases, we've got fuel and housing/housing services. So I want to dive into fuel. Here's the graph on fuel. So motor fuels is this dark blue. Transport as a whole is this light blue. I'm just trying to zoom in here because this line here is the zero line. Okay, so we can actually see that transport as an overall is still slightly negative year on year, and motor fuels is still something like, I think it's about minus 18% year on year. But we have to understand how this data is worked out, because anything that's a year on year trailing, if the year before was massively high, okay, then comparing it, even though month on month, right, we can see this month on month is spiking up, but year on year it's still down. So I believe, again, this is flattering the CPI data, because this time last year we were up here, which, by the way, if we go over to the graph, was about 40 odd% year on year increase this time last year in fuel. So we have this funny quirk in mathematics, how because we're doing a rolling year on year, we're still negative in terms of how this is contributing to the year-on-year inflation, even though the month-on-month is increasing. I don't know if that makes any sense at all, but inflation is a year-on-year factor. So even though costs are going up, year-on-year is still showing down. That is, I believe, flattering again. So let's just follow this to the logical conclusion, right? As we come down, as this falls out of the effectively the scan over the next month, if this continues going up, this is going to start to contribute to CPI or CPIH. It's going to contribute to both of them, as it's in both indices, a substantial amount. So this is something we need to watch, I would say, over the coming 1 to 6 months, and in fact 12 months time, the next year we need to see what's going to go on with these costs of motor fuels, and specifically that is linked to the price of Brent. Okay, so let's look at where we are. In fact, before we get to that, I just wanted to prove to you that, there you go, transport here, this is the line for transport. We are 12-month rate still minus 2.1%, okay, which is, even though it's a contributory factor to increase the CPI, when you actually put it all together, sorry, it went from minus 2.1% in July to minus 0.7% in August. So it's still a negative factor. It's still bringing the overall CPI figure down by that minus 0.75, which is, quirk of mathematics. Now, it's also, by the way, they've also put in this, and this is narrative within the CPI report itself, that the cost of motor fuel, right, in the transport section has been offset by cost of airfares. So it's saying that airfares fell 2.1% between July and August 23, compared with a rise of 13.4% a year ago. Interestingly, it says it's the only second time that fares have fallen between July and August since the monthly collection of prices began in 2001. The fall this year partially reflects a relatively high July 23 price, which may in turn relate to the departure date of flights priced and its proximity to school holiday periods. I just want to read this so I get it right. This year, July prices were collected for outward flights leaving on the 18th of July, whereas the departure date was the 12th of July last year. So what this is saying is, they're saying there's been a bigger fall in airfares than expected, and that's offsetting the petrol or the fuel price, motor fuel price. But they've actually changed the date they take that snapshot, so they are effectively looking at higher fares, which more closer to the sorry, let's go this year. July price was collected for outward bound flights leaving on 18th of July. Yeah, so it's proximity to school holiday, right? The prices are going to be high in July, which means when you then relate it to August, it's going to be a bigger drop. So I'm going to ask the question, why has that been changed? Why was that date changed? Why is it not a like-for-like comparison? Because surely if you're assessing a 12-month rolling figure, you want a like-for-like comparison. So I talked last week about some of this data seems to be manipulated in how the stats are being presented to us. And I'm not a conspiracy theorist. I don't want to be a conspiracy theorist, but our Prime Minister has put a very definite pledge. One of his main pledges is to get inflation to a certain figure by December of this year. Okay, so how are we going to do that? Statistics is one of these things that if you manipulate data sets, you manipulate the stats, you can come up with different figures, right, for all this sort of stuff. So we've seen a very definite a change in methodology here, which is, they've even said it in the report, has potentially skewed this data. Good question about why have they done that. The other thing is, let's face it, motor fuel, the full impact is not felt yet, or the increase in Brent crude is not yet felt. The main increase we're probably going to see is this September, okay, as it filters through. It could even depends on how high it goes. It'll carry on going. Airlines hedge. So another thing that goes into that, that discrepancy between the airlines. They say the airlines are bringing this down. Well, airlines hedge their buying, so they're probably still running on fuel that's been bought at lower prices. Businesses bulk buy in advance. In my scaffold business, right, we've got a massive, I think it's 2,000 litre storage unit for diesel to fuel our fleet, and we top it up at the beginning of the month, right? And that will probably last us 3 to 4 weeks. So we're buying 3 to 4 weeks earlier than the actual prices, if that makes sense. So we're putting fuel in that's cheaper right now. So the fuel that we bought is cheaper than the price of fuel now, if that makes sense. Fuel has gone up. So a lot of businesses are going to be doing that, buying bulk in advance, and there's going to be a huge amount of lag until this filters through the supply chain. So this cost here, right, this motor fuels price is purely the price of motor fuels. As all the companies that have supply chain, that fly, right, that have fleets, have truck, as that filters in, their margins are going to be squeezed again. I know last year our margins were squeezed by the amount of increase in our motor fuel, and therefore margins squeezed, you've got to put your prices up. So that's going to filter into the supply chain, okay? It's a logical conclusion that that's going to happen. So there's a lag until this really hits the supply chain. Now let's look at Brent, and I know I'm focusing on this fuel, but I think this is a major factor over the next 6 to 12 months. This is July. Average price of a barrel of Brent in July was $80, $80.1. In August, it was 86.16. So we've seen a jump of 80 to 86. It's just under 10%. It's about 8% jump in the average price per barrel between July and August. And that is the period that this is calculating. Let's look at where Brent is at the moment. So if we just cut off there, that's September, right? This is August this way. We're now pretty much probably averaging right now 90, I would say, in September so far. So it still continues up. So what we've seen this month in terms of the increase in costs, I would imagine, unless it suddenly comes down again quite significantly, we're just going to have to keep an eye on it over the next month. This is going to feed into next month's data. And don't forget, next month's data, if you look year on year trailing, right, the October went up 0.4%. So not a massive increase. So that's going to fall out. And we could easily see that rise in inflation next month, okay, rather than this month when all of these other contributing factors come out. So that is my view on the motor fuels. Now, the other contributory factor to upwards rises in CPI is housing services. This again is where I get a bugbear with the data and how it's presented. So if we look at it, this is all of the factors going into the inflation, and the household services, housing and household services is this sort of green thing here. So we can see housing and household services does make up the bulk of the CPI, mix of that bag of shopping, if you like. So it does make up the bulk, but it's still relatively small as a percentage of that whole bag of shopping compared to the reality of people's expenditure and what people are spending on it. Okay, so if we look at that, we see housing and household services. I'll just zoom on that for August 23, 1.77 of the 6.3% is housing and household services. So that's about, what's that, less than a third? Maybe about a third. So a third of the CPI print is housing and household services. But I suggest most people in their paycheck, most regular people in their paychecks are spending more than a third of their paycheck on housing and housing services. So how valid is this as a mechanism to see people's affordability? And if we break it down even further, so we now want to break down the housing and household services into the owner-occupier housing costs. If I just zoom in on this, okay, this light blue up here is utilities. So we can see obviously that spiked down. This is the owner-occupier housing cost element here, which is getting bigger and bigger. This green one, by the way, this light green one is rents. So we can see the rents are increasing as well. Okay, so owner-occupier housing costs are steadily increasing. Nobody seems to be talking about this particularly. But why do I feel this is flawed data? And when I say flawed data, I'm not saying that they're making it up. I'm just saying the way it's being statistically used is potentially flawed data. So we need to understand that. So why do we care about the data in the CPI print? Number one, Bank of England base rate. The MPC are using this pretty much as their guiding light of what they do with interest rates. Okay, is inflation solved? We can bring interest rates down. Is inflation still sticky? We keep interest rates where they are, or we put them up more. It's literally that binary right now. So if the data is skewed, or if this data is potentially being presented in a way that looks more favorable, is this going to affect the route of interest rates? If we come off interest rates too quickly, which I don't think we will do, by the way, does that lead to secondary inflation? If we go too heavy, does that break the economy? Does that put businesses under? That puts us into recession? Does it crash the housing market? So we've got to make sure we're using, an accurate data set. For me, as a property person, when I'm looking and narrating on the housing market, I want to know what the actual measure of affordability is for people. Because when I'm looking at the housing market as a whole, and I talk about this when we look at the housing market indices, there's three crisis triggers we want to talk about. One is people going to negative equity. The other is the increase in unemployment. And the third is people's affordability. Now, people's affordability in the housing sector, obviously it makes sense that for people to not afford their houses, they have to own them. Therefore, affordability is directly linked to owner-occupier housing costs. So if owner-occupier housing costs are not being reported accurately, right, then actually we could be in a much worse position with people's affordability than actually this data is saying. So let's dive into that a little bit more fully, right? So let's look at that OOH data. So I've already shown this. We can see it's marching on at a pace. If anything, it is accelerating its pace of increase right now. Now, I believe this particular line item from the CPI bucket is underweighted significantly. Okay, so when we look at this, and it's all the way down here, it's coming up, but it's still low. It's still way below the rest of the lines. Actually, Just the fact, right, that CPIH, so this dark blue line here, is less than the light blue line, CPI. By the way, this has nothing to do with core inflation. Please forget core inflation for now. We're talking, the only difference between CPI and CPIH is that CPIH includes owner-occupier housing costs. So the very fact that the dark blue line of CPIH is lower than CPI means the owner-occupier housing costs are actually making it less. They're showing inflation to be less when you put the owner-occupier housing costs in. And when you follow that through logically with where we are right now in the cycle, with interest rates where they are and people coming off fixed rate mortgages and the amount of interest they're paying, etc., how can that be lower than the main rate of inflation? I don't buy it. I don't believe it, right? And if we sort of analyze this, these are the reasons I believe it's underweighted. Number one is owner-occupier housing costs use a metric or a method called the rental equivalence value to calculate. So I just want to try and explain this. That there are three ways that the ONS define owner-occupier housing costs and how you can calculate owner-occupier housing costs. If you think about it, what are the costs for an owner-occupier? The maintenance of the house is one, sort of running of the house. Things like council tax are separate, by the way. The big one is probably the interest you're spending on your mortgage. If you buy a house, one of the costs is interest. However, that's not a fair comparison to use because not everybody is going to have a mortgage and people are going to have different levels of mortgage, different interest rates. And also people are actually potentially in a rising market making money from their properties. That's offsetting it. So there's lots of factors that are conflicting there to actually come up with a nice model. So one of the models is things like mortgage costs, but the one they use for the CPI print is rental equivalence value, which means they take the same house and they calculate how much it would cost somebody to rent that house. That's the cost for owner-occupier housing costs. That's how they sort of baseline it because it's kind of the fairest way of doing that. But what does that actually mean as a metric? So if we look at the ONS figures for the private rental percentage change graph, this is from the last report. By the way, you can see this is still going stratospherically high. But it's still not that high in terms of percentage, right? We're just now touching 6% year on year in terms of rental values going up. Now, a lot of people are going, wait a minute, rents are going up more than 6% a year. And if I zoom out and go into Zoopla's latest UK rental growth, right? Zoopla says it's in double figures. So it has come down a little bit. You know, we've had a little pump, but we're still double digits, right? It's 10%. So where's the discrepancy? Here's the discrepancy, right? This is all rentals. So there's going to be lots of people who are long-term tenants with landlords who are not just ramping the price up every 6 months or every 12 months, okay? These are new rentals. So when a tenant leaves and a landlord puts a new tenant in, they're going to get a much bigger chunk. Now, both of these have a massive lag in the system because you're not going to see, on this, you're not going to see rents going up until the landlord puts the rent up, and you can only put rent up once a year. With these bigger spikes, you're only going to see that when you put a new tenant in, then it's not going to be able to do anything for another year. So it's kind of locked in for a year. So there's a big lag in this system. And also, I believe that the rental equivalent value effectively is going to be using this ONS data, which is probably quite a lot beneath where new rents are going. So I feel, right, this rental equivalence value is massively underweighting the owner-occupier housing costs. Especially now we're seeing the real cost for people with coming off fixed rate mortgages and having, double, triple, quadruple mortgages in terms of their monthly. Now, what this says, so have I got that right? Yeah, rental equivalence value. I'm just going to go through this next slide. This again is deep from the report. So the owner-occupier housing cost component accounts for 16% of the CPIH. So all of this anyway, all of it together is accounting for 16% of the basket, owning that house. Now, if we have a look at this, this is a big piece of research that ASDA did earlier in the year. This is average, so it's not rich, elite, super wealthy. This is the average total income per household. Okay, on 930. This is quite out of date now, by the way, but I've not seen a new one. What's that? March. This is half a year out of date. Essential spending £508 a week. Taxes £144 per week. Average family spending power £210 per week. Right. So a lot of this essential spending is food, housing, utilities. So therefore, when you look at the components here, right, I would say they are underweighted for where the average person is spending their pay packet. So when we are looking at this affordability, okay, this affordability thing, I believe it's underreporting quite a lot. Now, so that's the actual household budget. The final thing that I believe is flawed in this data is the CPI weighting itself. And this is, we just talked about it there, owner-occupier housing, 16%. It feels low to me in terms of the bucket. And this is what I went through a couple of weeks ago when I went through the weightings. Now, I'm going to go to the weightings in a little bit, but what's important to understand is that this bucket, this basket of CPI goods, all of these goods, and there's lots and lots of line items in there in what makes up the CPI basket, has a weighting on it to reflect how we spend, percentages of how we spend in our pay packets, right? Now, every year they rebase this. And last week, when I went through this, I was massively surprised at some of the rebasing that happened at the beginning of this year, where we saw a massive skew and rebase for accommodation and hotels and restaurants, almost doubled over the last 3 years in terms of the weighting that got. And the weighting of housing, owner-occupier housing, has fallen fairly considerably, which feels to me a little bit like we're manipulating that, right? So we can see things that are coming down are going to have a higher impact weighting-wise on the overall CPI figure. So if something's weighted higher and it's coming down, that negative movement is going to have more factor. If something is going up and it's weighted less, the positive factor is going to be less, right? So basically, you're able to manipulate the CPI figure by changing the weighting. So I got a little bit upset about this. I've dived more into it over the last week to find out their explanation. Okay, this is the explanation I found. Basically, what they've done traditionally is they have rebased, or they rebase on the spending patterns of people 2 years ago. So they'll look back 2 years and go, what was the spending patterns 2 years ago? We'll rebase based on those spending patterns for the next year. They have acknowledged that COVID has changed things considerably, and therefore they are now trying to rebase more rapidly. Okay, so you can see, I don't know if you can read it. I'm not going to read it out for you, but they're saying with COVID, they're trying now to do it more rapidly. If we read this down here for the retail price index, the 2023 weights, now this is obviously CPI, not RPI, but they're talking about RPI. The 2023 weights are based on spending patterns for the 12 months ending June 22 from our cost and food survey. So even on the RPI, they're not doing it two-year trailing. They've brought it forwards. They're looking effectively from July 21 to June 22. They're looking at the spending patterns there and then rebasing 2023 weights. Now, if we follow this through, right? If you remember, in the UK, we came out of second big lockdown. We went into second big lockdown just after Christmas 2020, so it was the beginning of 2021. So we're in that lockdown at the beginning of 2021. When we came out of it, right, the whole sector started to wake up again with people who had lots of money to spend, furlough money, bounce back loan money, which I know there shouldn't be, all of these sort of things, a lot of liquidity. We'd had people have been taking mortgage payment holidays, interest rates were down at 0.1%, everybody's flush with cash. We've been cooped up for about a year, nobody had been anywhere, everybody went out, went to hotels, went to restaurants, right, and probably spent quite a large proportion of their excess cash flow at that point into 2021 and beginning of 2022 on that sector. So if you look back on it, I think it's probably fair to look back on that time and go, yes, it's fair that people were spending more on restaurants and hotels in that period. But we've now completely flip-flopped around in terms of this cost of living crisis. So we've rebased based on that, okay, and we've increased those weightings for those sectors quite a lot. And don't forget, we also had rents weren't spiking up at that point. We were still on cheap debt. So actually the owner-occupier housing costs and housing services would have been less as a percentage, especially with people taking mortgage holidays. I don't know if that fed into it or not in the rebasing. So that went lower weighting. But now it's all pivoted, right? So if we actually look at these weights, if I show you this, if we go restaurants and hotels, which is this one here, you can see in 2021, it was 68. By the way, this is parts of 1,000, so it all adds up to 1,000. Restaurants and hotels had a 68 1,000th weighting. Now it's 112 per 1,000. So it's almost doubled in terms of its weighting. However, that's going to be, that surge in spending on restaurants and hotels is almost inevitably dropped off in the cost of living crisis. If we look at owner-occupiers housing costs, Jan 21, the weighting was 185. It's now 160. So that correlates with that 16% that we looked at, that it said in the narrative here. OOH accounts for 16% of the CPIH, right? So that was 18.5%. So it's been weighted down. So the thing that's going up has been weighted down in CPI. Things that are coming down have been weighted up in CPI. And I do believe this is changing, right? If we had a level playing field and we're doing a direct comparison year on year, I think inflation would be much higher, is where I'm going with this. I think it's incredible that owner-occupier housing cost is 16%. Okay, 11.2% of the CPI is restaurants and hotels. I'm going to ask anybody a question here. Ask anybody. I'm probably going to get some yeses now. Who reckons they spend on average 11.2% of their money every month on restaurants and hotels? I certainly don't. Do you reckon you are spending? So that's about. Do you reckon your restaurant and hotel bill is more than half of your owner-occupier housing costs? If you actually go for rents, okay, here's another one, right? So let's just go into the weighting. Actual rents for housing, 74 down to 64. How can the weighting for rents be lower now with the rental crisis that we're going into? Basically, this is saying that it's giving 11% for restaurants and hotels and 6.4% for actual rents for housing. Something does not make sense there in my mind. Now, the question I have with this is, let's go to this column here, which isn't done yet. We go into 2024. If they are following their methodology, they're going to rebase. Are they going to rebase and look at this year's spending habits? And are these figures going to change? And if these figures change, is that going to have a material impact to the CPI print as we go into 2024? That is a question that I have. As I said, team, I'm not making conspiracy theories here. You can look at this. You can look at this in one of three ways, I think. I believe somebody said, I don't know where I saw it, or if somebody said it to me, that a lot of the ONS employees were made redundant, or they moved offices to Cardiff and lost a lot of people. So we can look at this and say, on the one hand, best case scenario, right? These guys are trying really hard to keep up with what is a very rapid paced changing scenario, right? Our environment is changing very quickly. We're in constant turbulence and chaos. That must be very difficult for statisticians to keep on top of. That's one. Second, this could just be pure incompetence, right? The fact that these are what the weightings now are. That might be mean and hard on people. The third is actually they're really bloody clever. And this is done on purpose to get that CPI figure to where Sunak needs it to be for his pledge of halving it. But if we halve it, what's going to happen next year? This is why I cannot see this just suddenly dropping off a cliff and us going to nothing. When you look at this, it's that owner-occupier housing cost that's going to carry on marching on, because that lag. Don't forget, those rents are still going up, and if we're using that rental equivalency value, the more people that renew and go on new rents, that's going to carry on going up. In real times, the amount of people that are coming off cheap fixed rate debt is still 1.6 million between now and the end of next year. Okay, so in real times, people affordability, even with the headline rate of inflation coming down, affordability is being squeezed. So what can we make in terms of predictions on this, future predictions? Well, I've already gone through this and showed how September last year we had a 0.4, then we got a big old one of 1.6. So I would suspect we're going to see a little tick up in September and probably a tick down in October. Then the next quarter I think is going to be really interesting. It's too far out to know what the cost of oil is going to be and how that goes into the supply chain, if there's going to be any other shocks that come into the system. I do think we've solved the energy problem. But even though we've solved the energy problem, there's no sort of predictions of it spiking up again this winter, unless, I don't know, something else happens from third-party sources or third-party inputs. But it's still not going to be coming down massively in terms of what we're actually paying for it. So yes, the headline rates come down. I have seen that the price cap has been set for the next quarter. It's come down a little bit again. I think it's come down to just below £2,000 a year. It was still significantly more than before the energy crisis. That's because of the forward buying prices. But it's certainly not looking at spiking up. So that's good news. We need to look at that as well. So what do I think? I think the rising owner-occupier housing costs, because there's so much lag in the system, it's going to carry on up. and I think that's going to push CPIH up eventually. So at the moment, it's still actually making CPIH lower than CPI. I think we'll have a crossover point where that's not the case, and it pushes everything up again. Cost of fuel is still rising right now. I know Brent's come down a little bit over the last few days, but it's still rising. We haven't had, that sort of 80s into 90s come into the figures yet in terms of dollar per barrel, and it's going to be laggy getting into the supply chain. So I see next month is going to start to get into the supply chain. And are they going to rebase January 24 to increase OOH? I personally think they should do. But there we go. That is my overall thoughts on the CPI print. What are they going to do to base rate tomorrow? Look, they're going to put it up 0.25%, aren't they? You can't look at that and go they're going to pause or drop it. I think the real question is going to be how does it play out over the next quarter or so? And obviously that input of Brent crude going up is going to potentially derail a lot of the work that's gone on. Let's look at America, right? Inflation's back up. If you look at France, inflation's back. I say back up, ticked up already in America, ticked up already in France. We seem to be lagging behind everybody else in that. We're still above everybody else. That's worth sort of talking about in the sort of G7, and we're still highest in that. We're still on the way down slightly, but I would be amazed if we don't see a tick up in the next month. There we go. Okay. Let me know what your thoughts are on that, team. I'm going to go through some questions now and see how we're doing. By the way, give me a thumbs up if that was useful to go through that data, and if that helps you make any decisions at all about what they're going to do with interest rates and therefore what's going to happen with the property market. I suspect tomorrow we'll go 5.25 to 5.5, and then we'll wait and see. I personally see it going higher. I do see it going higher, but might be wrong. Neil says CPI about to go boom with the oil price surge in Q4. There we go, Neil. I think we agree. John came out of fixed rate from Halifax from 2.3% ish and now on a variable rate. How can Halifax get away with putting it to 8.34%? Oh my God, John. I don't understand as they keep upping the interest rate. Is that on a variable or is that just a standard variable rate? Or have you gone onto a variable rate mortgage? That seems extreme. Neil, upward price of oil will take weeks, months to properly affect consumers. We're in agreement, Neil. Thanks for your comment on that. I think hopefully covered that. PSR, Rob, you make some decent points, but can I ask what makes you qualified to comment on these data sets? Is it just interest in the topic, data or more? Yeah, great question, PSR. Absolutely nothing makes me qualified. You should not take my advice and use it as investment advice. I'm some dude on YouTube who likes to look at stats and figures and try and forward project based on the actual data. I've been doing this for 15 years in terms of growing businesses and investing in property. And at the beginning, I didn't care about any of this sort of stuff. And I went through a phase of going through personal development, like a lot of people do. I went and did sort of training courses, which were great. But something they said is, don't be a neckhead, right? Everything is always brilliant. If you just go in with that positive mental attitude, you'll always win. And what else did they say? Never watch the news. I think that's really stupid advice, personally. I think it's really important to understand where things are going. Since doing that, going in with the bullish, I'm all positive because I've been pumped up at a course over a weekend. I'm going to invest in stuff and take shortcuts and not look at the data and not do the risk mitigation. I would say I've lost hundreds of thousands of pounds over the last 15 years by making bad investment decisions on ill-informed data without looking at it. So after going through a period of that, you start to realize that you need to understand what's going on a macro level. Okay. It's not just a case of, still see the property experts out there saying property doubles every 10 years. Wrong, it does not, right? Statistically, yes, over the last 70, if you do every rolling 10 for the last 70, that's all skewed for the first 30 years of that period. Go and look at the rolling 10 from peak. November 22 was the peak. Go and look at every 10 years before then. Property does not double every 10 years, right? It's a compressing thing. Doesn't mean that's not going to change, but it's so easy to listen to these sound bites that are out there on YouTube or mainstream media or Insta or TikTok or whatever and make really bad investment decisions. So the reason that I do this is I personally love looking at the data and trying to see where the trends are going, make investment decisions based on that, or financial decisions based on that. And then I quite enjoy sharing it with you guys. And if it's useful, then it's useful. So the honest answer is nothing qualifies me other than 15 years of experience investing. Stafford, I hope that answers the question, by the way. Is that a satisfactory answer to the question, PSR? Stafford, our rental went from 900 to 1200 with the new tenants, Southwest area. That is a big increase. Wow, look at that. That's a 30% increase. Those figures do not make sense, as you say, with skewed results. Yeah. Sorry, I'm just going through all the comments as we go through, guys. Stafford, rapid change in society with very unusual historical figures don't work together. Agreed. Sean, 0.1% drop is insignificant. I stick with my prediction of sticky inflation driving rates up further. Sean, I'm in agreement with you, which I like to be in agreement with people who are looking at the channel. Sean, love the data and the slides. I work as data manager in the energy sector, and your analysis is great. I very much appreciate that sentiment, Sean. Thank you very much. And the Harpers, you are very welcome. Good to see you back on alive. All right, team. If you've got any other questions, let me know. It is been on for 45 minutes. Hopefully, we went data first and got through the data as quickly as possible before going through comments and questions. I know a lot of people are saying, can we try and get the data more succinct? I've got to be honest with you, team. Full transparency, I'm not a full-time YouTuber, right? I'm a full-time business owner, and I have a group of scaffolding companies. I'm a full-time property investor, and we're in several deals at the moment. So this is stuff that I do kind of when I've got a bit of time during the day, put the slides together, do the research to come and do this. I only have limited resources. I would love to be able to have, lots of different things that I put out every time a data set comes out. Getting on the live and doing on the live for me is the easiest way of getting it out and having a chat and building a community, which is what I'm trying to do and what my vision is here, to build that community, not just around property, but just around empowering you to take control of your lives, of your, sort of basically take control of your life through investing in various asset classes, whatever that is. And I'm not an expert in lots of them, but I do consider I know a few things about property and businesses. Okay. Yeah, as pound is falling, which adds to import inflation. Yeah, there we go. All right. I don't know if you can hear. It's absolutely tipping it down. I'm in my studio is in an external workshop in just outside of my house. So it's got a wooden roof. So it's you probably can't hear it, but it sounds like World War III is about to break out. All right, team. I'm going to leave you for the evening. I'm actually away for the next five or 6 days, taking a little break. I've been working quite hard, so there's going to be no lives until probably, actually, I'm away for a long weekend, but then I'm up in Chester with some of my property stuff, so it might be a week or so until I'm live again. So I'll try and get some pre-recorded stuff out if I can, but otherwise, I look forward to tuning in, or you tuning in to the next one, whatever that next data set is. I think it's probably going to be Bank of England base rate tomorrow. I'm not going to be going live tomorrow. I don't see the need to go live and analyze what's probably going to be a 0.25% rise tomorrow. Let's just see what happens. And if anything really weird happens, I'll probably go live in the afternoon and just have a chat about it. Team, it's been an absolute pleasure. PSR, I'm glad that was a good answer. I'll do what I can, do my best. But please, nobody take this as investment advice. I'm not a qualified financial advisor in the slightest, which I'd suggest not a lot of people on YouTube actually are. But I'd like to do things more objectively than some. Okay. Everybody have a great weekend. I'll see you next week. Much love.